narrow our market focus, and we are very much working on building our software platform for helping B2B SaaS companies price their offers and communicate that price in the market so that they can capture much higher prices, accelerate their pipeline, and improve key metrics such as NDR. And just as a bit of background as to how this came about, we found that our best channel to market has been to work with private equity funds and venture capital funds. So we are working with people such as OpenView in Boston, Arthur Ventures in Denver, Apex in Paris, and most especially Peakspan and Cota Capital in San Francisco. And Peakspan a couple of months ago said, look, our portfolio companies are really struggling to improve net dollar retention, and net dollar retention is the metric that we are most concerned with in the current environment. Can you put together a masterclass for us on net dollar retention? So Karen and I, who many of you know, did this, and we did a webinar a few weeks ago for Peakspan's portfolio companies and for their pipeline companies. So we had about 100 people in the webinar on net dollar retention. And it was successful enough that Peakspan has asked us to do 2 more masterclasses, one in June and one in September. The one in June will be on pricing diagnostics. How can you tell if you have a pricing problem and how can you act quickly to deal with it? And then the one in September will be on how does one price for different types of growth motion, and what's the difference between pricing for product-led growth versus pricing for community-led growth, and so on. We wanted to offer this this content to the VanTech and eFund and What If community as well, since we're part of that community, and it's sort of critical to our success. And so that's what we've done. We are going to be giving a seminar or this webinar on net dollar retention later on in June. So, who is this for? It's really very much for SaaS company leaders, the CEOs, board members, the person responsible for revenue, the chief product officer, the CFO, really anyone who needs to monitor or deliver on net dollar retention, and to do so in order to improve revenue growth, cash flow, and profitability, all of which are critical issues for companies in the current economic climate. What we're going to talk about is why NDR matters now, the impact of pricing on company valuation, something of concern to all eFund members, the relationship between pricing and net dollar retention. We're going to give a case study where we showed how specific pricing and packaging actions impacted pricing and churn at one of Ibakka's major customers. And then we're going to give a challenge, and we're going to invite people to think about how their current pricing design drives account expansion. And finally, we have a takeaway, a simple checklist that people can use to improve NDR. So I'm not going to go into the too much into the content right now. I'll just note that, as we're all aware, that inflation has led to higher interest rates, which has caused an economic slowdown and raised the cost of capital, changing buyer patterns. Investors have changed how they think about valuation. Revenue multiples are down. Cash flow is seen as very important in follow-on investments, and people care much more about profitability than they did 2 years ago. The operating metrics that matter have changed. Net cash flow is now very important. Operating efficiency is very important, and people are paying much more attention to customer acquisition costs. Net dollar retention matters because it's a very cost-effective way to grow. Customer acquisition costs are lower and implementation costs tend to be lower. And it is closely related to predictable growth. This is a very important thing, I think, for eFund members to understand. So because Ibakka works with a number of major venture capital companies, we've got some pretty good insight into how larger and follow-on investors are looking at net dollar retention. And these ratios are to some extent dependent on the category, the type of product, the company stage and customer profile. But in fact, we found these to be pretty good representatives of what major VCs in the United States and Europe are thinking. And it's critical when working on NDR to understand that there are both positive and negative factors and how these relate. And during the webinar, we go into detail on each of the three positive factors where you get to accentuate the positive, and the three negative factors where you have to eliminate the negative. And I will not try to sing that song. I'm going to stop there and let people ask questions or comment about this webinar.
Any questions for Steven? I have one. You talked about company valuation. It's like in pre-times, it's been argued that valuations were frothy, and now now they are considered to be closer to their true value. So, two questions related to that. One, is that a fair statement? And two, what were the multiples on revenue before and what the multiples on revenues are now?
So very good questions. We do have some insight into that, but we get quite different ranges. So I'm actually going to push back, Delzel, and say I don't actually agree that the previous revenue multiples were frothy. The previous revenue multiples were based on growth. And if growth slows down, the revenue multiples go down as well. And there has been a general reduction in growth in the SaaS business. So it should be expected that revenue multiples would go down as growth goes down. And if and when growth goes up, then revenue multiples will go back up. And for companies whose growth has continued to be very robust, revenue multiples have not gone down. So the revenue, and we're seeing quite a bit of range in the revenue multiples. But I would say in general, for companies at in the growth stage or the scale up stage, the multiples are all the way down to, at the low end, 3x, 12-month forward ARR, although most are probably more like 5x 12-month forward ARR. And there's still companies with rapid growth that are in hot segments like AI that are seeing 15 to 20 times 12-month forward ARR. So it really depends on growth, but I think the other thing that's really changed, it hasn't, is that people are starting to understand that the story that people like to tell themselves, that SaaS companies enjoyed frictionless growth, and that variable costs for SaaS companies were close to zero. That has been proven wrong. And it will be proven more wrong over the next 3 years, and for two reasons. One is it's increasingly acknowledged now that customer success is a cost of goods sold. So when you're analyzing the P&L statements of portfolio companies and potential investments, make sure that you put customer success as part of COGS. And in most companies, it's below the line, but it should not be because it's actually a variable cost. And then the second issue is that more and more companies are relying on artificial intelligence in order to drive innovation. And AI is expensive. It's computationally expensive, and it's it's a variable cost. So unless the company is building and owning its own models and selling those models and does not have variable costs related to the model, and I would suggest that there are no companies of which that is true, although I come along those that claim it, probably once a week. The variable costs of AI are going to be greater than the historical variable costs in legacy SaaS. So the widespread adoption of AI, and I was just reading a report by Tom Tungas at Theory Capital, I think is his new VC's name, that there have been about 2,500 investments in content generation AI companies. These companies are going to have higher variable costs than conventional SaaS companies have had, and that's going to drive down ARR multiples. And I think it will lead people to question whether ARR multiples are the right way to value companies. I don't think, I've never thought that 12-month forward ARR was a good way to value a company. I'd suggest that the aggregate lifetime value of the customer base, with lifetime value being the net lifetime value after cost of service deducted, is a far more compelling way to value companies going forward. But then I've been saying that for the last couple of years, and it doesn't look like most VCs are listening to me. So take that with a grain of salt.
Okay. Oh, thanks. Anybody want to ask any more questions? Those of you who asked in the chat, this is being recorded. It will be in the investor only section of eFund website. So you just have to log in with your credentials and you'll be able to access this presentation. Pricing strategy. Yeah. Okay. Somebody has a question?
Yeah, Steven, are you okay if we share the link to your webinar via Ventec here in the chat?
Yes, absolutely. Please do. Please do. And I noticed that New Ventures BC shared it recently as well. And you can share the short, you can put the short slide deck, Thelzel and Frank, into the eFund chat as well, or the eFund resources as well. We have some deeper data that we can probably share just with eFund. So Thelzel, some questions on what we're seeing around valuation multiples, what we're seeing around actual NDR performance. So we actually have a database of that, which we can probably share with eFund.
Okay, because that'd be very useful, because valuation is a topic near and dear to our hearts as we put investments in companies.
Even better, how do we increase valuation is what we really care about.
Yeah, because we do have some SaaS companies in our portfolio.
Yeah.
Anybody have any more questions for Steven?
Yeah. One thing that may be of interest to people. So we are going to be working with PeakSpan, which is a San Francisco, New York VC, on putting together a framework for investing in and managing pricing and monetization of AI-driven companies. So that's something that we've got the initial bones built, but we are going to be investing in that and including some aspects of that into our own software platform, which of course has its own AI that we use in order to generate value models and pricing models and optimize pricing. So I'm going to have some conversations with PeakSpan about what's public and what we can share with people like eFund and what's proprietary to PeakSpan. But you know that old Mark Andreessen quote that software is eating the world. Well, I think it's now fair to say that AI is eating software.
Bigger fish. Okay. Well, we're just out of time now. I really appreciate you sharing this, Stephen, and we've got the link in the chat for anyone who wants to do a deeper dive. We've been doing lots of diving in this hour about the pricing strategy, pricing optimization masterclass webinar. So just click on the link and please sign up. Support our fellow eFunder.
And encourage your the companies that you're associated with to participate.
That's a great idea, especially the ones that are working on recurring revenues, SaaS or not. Okay. If there are no more questions for Stephen, we're going to move on into our online network.